Excellent. I want to thank FIM for inviting me here to speak with you today. It's been an interesting period the last year or so, and what I hope to do is talk a little bit today about what happened over the last 12 months or so, really longer, 24 months you could argue, and where we are today, what's been happening in terms of responses, whether it be government, corporates, institutional investors, and even ultimately the distributors in the marketplace, and how the actions are coming together to hopefully, over time, restore investor confidence. I don't think we're fully there yet, but we've made a lot of progress, and I'll outline some of those issues today. And then I'll conclude briefly with our outlook on the markets. That wasn't really the objective, but I thought it's worth sharing some of our more recent thoughts with you in summary at the end, and then highlight some of the issues that might be relevant going into next year. Okay, let me just jump. Whoops, sorry, wrong direction. You know, last year was really a sequence of events, and I sort of laid out in the table here the dominoes, all the financial institutions that sort of ran into problems and how one event triggered another and so on down the line. Essentially, you know, major changes in the financial landscape were taking shape over the last decade or so. Probably at the root of that was a shift from banks sort of taking on deposits, intermediating risk, and then lending on the other side. The development of the capital markets really accelerated through the 90s through securitizations. We saw that firsthand in the mortgage markets, and the problem really emanated from the mortgage markets. And you can see companies like Northern Rock, Bear Stearns, Fannie and Freddie, of course, being sort of the elephants in the room in the mortgage space, and how that trickled down to affect other institutions over time. Last year was characterized just by sheer financial panic, near collapse of the global system, and unprecedented policy responses on the part of regulators. Really a time of extreme fear was the way I would have characterized the end of last year. Wrong direction. You know, and as I said, the root of the problem was the relationship between lenders and borrowers broke down through through the process of securitization. That risks were not just originated with the view that, you know, I'm taking a view over the life of the borrower, but was rather, I'm taking a view over the life of my exposure to the borrower and hoping to move that exposure to someone else before things go wrong. And essentially, that's the root of it. What we saw then is the housing market turned and shook. And recall about a year ago, observers were out there saying the U.S. house prices have never fallen in the history of house prices in the U.S. on a nationwide basis. Well, that was proven wrong quite decidedly last year as the collapse in the subprime market triggered a broad nationwide decline in house prices as measured by the Case-Shiller Index. That had multiple consequences. One, directly in the financial institutions with exposure. Secondarily, in the form of consumer confidence and spending, and you can see that in the chart here in terms of retail sales as a proxy, that things came to a standstill. And above and beyond that, as financials were faced with this period of panic, they stopped lending to one another, and I'll come to that in a moment. I'm not used to this remote. I keep going the wrong direction. As we saw as well, the impact over time as the economy stalled was a massive rise in unemployment. We've seen significant adjustment. We're up at numbers that we haven't seen in decades. 8.6 or so, most recent on the official definition, but if you start to look at the broader definitions and you take a state like California, the broadest definition in California is pushing numbers of 17.7% if you add in those that are not looking for work anymore, that have fallen out of that statistic. So we're still in that adjustment process on the employment side, and this is one of the factors we're very focused on as we look at the current year. Again, I won't go through these charts in detail because I know my time is limited, but you know, again, the sequencing of events starting in 2007, and I would even go as far as to say the signs of the crisis surfaced probably more in end of 2006. I don't know if you recall, but HSBC came out and said their household business was sitting on significant exposures in subprime. They took, I think it was a $3 billion charge at that point to clean up parts of that balance sheet. That was as far back as 2006, end of 2006. But as you roll through time, you can start to see the events become bigger. And then lo and behold, the effects on the markets around September of last year with the bankruptcy of Lehman, markets took a major hit and a major setback. And this is when the financial markets came to almost a standstill in terms of the corporate paper markets across the globe. again, the LIBOR-OIS spread, which is a proxy for the willingness of institutions to lend to one another, spiked at that point in time, reflecting the levels of distress in the financial markets. I'm going to jump ahead here. The real economy, that's where the transmission mechanism accelerated, and you started to see the effects on the corporate sector. Corporates were not able to get liquidity, trade financing, et cetera. And the global economy, that's where the financial crisis became an economic crisis. And you can see the decline in exports, 45 or so percentage point decline in regional exports from Asia as a result of the downturn in the developed world. The following chart just sort of illustrates the rise in charge-offs or write-offs across the global financials in relation to the share price performance. And one point I wanted to make is that the pain wasn't evenly distributed. There are players that were actually fairly well positioned, although this chart, you might think twice about that, but US Bancorp is a good example. The lighter line up here had suffered a significantly lesser decline than some of the more exposed larger cap banks with the subprime exposures. Now, this is something I want you to think about. I mean, the whole sector, of course, was exposed. Policy responses were geared towards, on the part of governments, dealing with the worst linkages in the chain, which is probably the right way to have worked in the initial phases. I think the question mark going forward is, could the capital have been better utilized by looking at other solutions? I think yes is the answer to that, but that's another debate in itself, and I probably won't go there today. Again, this bear market in relation to prior, it's in line with many of the four major market corrections. It ranks right up there with the worst of the last large four bear markets. The 29 episode is obviously the light gray line. We have seen, though, however, policy responses has resulted in a significant recovery in markets. I think a large part of the easy money has been made, and I'll come back to that later. But there's a lot that needs to be done now to continue to build on confidence that's already been established. And we'll talk about it, as I said at the beginning, four areas really. Government responses, corporates, how are they responding and thinking about positioning for the future and dealing with their investor bases. Institutional investors, what pressures are they bringing to bear to reinforce the governance requirements to rebuild confidence? And then lastly, the distributors that deal with the retail investors. What are the issues they're facing, and how are they going to think about managing risks across the marketplace and ensuring that they don't compromise their reputations to make money in the short run? I will skip over. This is a bit slow, so let me just jump through this. Firstly, on the government side of things, I put this picture in there. I thought it was pretty reflective of the challenges faced. You have Paulson with his head in his hands last year, Bernanke sort of looking fairly thoughtful in terms of what are they going to do next. It really was a maze of activity. I sit back today, looking back a year ago. I mean, today is the 15th of October, if you note. A year ago at this time, we had, I think, they just passed or announced that they were going to modify some of the legislation related to the rescue and the bailout of bad assets and redeploy $250 billion from buying toxic assets from the banks to actually putting capital into the largest institutions in the U.S. This was announced a year ago today as we speak, which was pretty controversial. I think it was in response to Gordon Brown's decision to do the same in the UK and the fact that the markets had taken it so favorably. There's a whole host of questions that should be raised when you start to see governments moving directly into the corporate sector and sort of picking winners and losers. But again, that's a topic I won't get into in detail. I'm going to focus in specifically on monetary response, some of the capital support measures, and lastly, the fiscal stimulus. And the fiscal stimulus will be probably the topic that will linger as we go forward into 2010. Firstly, on the liquidity front, we had not only direct lending to banks against a broader range of securities than had ever been lent against in the past on the part of the central banks, but we also had measures to support the commercial, the money markets in the form of the commercial paper support facilities, and then also swap lines with central banks across the world, whether it be in Europe or even all the way through to Asia, put in place by the Fed. The Fed was very quick in trying to put in mechanisms to push liquidity out into the broader economy.